I'm just going to give 1 more minute as everyone start getting logged on as participants. Okay, time to start. Okay, thank you everyone for joining another webinar brought to you by Blockchain Association of Singapore. This is a series of webinar that's concentrating on certain topics that's definitely of interest to the public who are involved in not just blockchain or cryptocurrency, but as well as general payment services, as well as financial services related to blockchain and stuff like that being given under Blockchain Association of Singapore. Now, today's webinar is brought to you by two subcommittee of the Blockchain Association of Singapore, namely the Regulatory and Compliance Subcommittee, as well as the Digital Exchange Subcommittee. Now, both heads are actually in this particular conference today, namely the head of the Regulatory and Compliance Subcommittee, Nizam Ismail, I think no stranger to anyone that's actually in this space. And then we have Thomas McMahon, who is going to be the head of the Digital Exchange Subcommittee, right? Also in this space, he will represent together with a few of the other folks on the panel today that represents exchanges operating in Singapore. Definitely a lot of exchanges have a lot of concerns going on with all the various changes in regulations in PSA in Singapore. So thank you for joining us. So today's topic is regards to some amendments that MAS actually released with regards to the Payment Services Act just some time ago. So this is a discussion on that and probably to share with you what exactly it means. This is going to be the first of a couple of series because MAS did actually release a couple of amendments as well as like changes that will be articulated properly in the other webinars as well. So stay tuned. We will be sending you information about that, right? More than happy for you to participate. Now, this is an interactive session today while we are going through a particular explanation by Nizam with regards to what it means for you in terms of amendment. We will be going through a panel discussion, whole sets of very detailed questions that I think is very close to your heart with regards to what's happening. Last but not least, we will be accepting questions from the audience. So if you have any question, feel free to actually click on the button that says Q&A, right? Use that to ask your questions and then we'll be able to answer it to you as much as we can until the end of the webinar. Now, without further ado, let me hand the floor over to Nizam. Thank you.
Thanks very much, Kevin, and very good afternoon, everyone. Thank you for joining us this afternoon to discuss what the changes to the Payment Services Act means to you. Let me just share my screen. So give me a second. Okay, voila. All right. Well, I think it has been a very busy time clearly for the regulators since the enactment of the PSA. We have seen multiple consultation papers that have been issued since January of this year, a lot of which touching this community, the blockchain community, the crypto community. And this Payment Services Act, remember that there was a consultation paper that was issued in December of last year. And that's before the PSA was implemented this year. So these, the act finally came, the bill finally has been drafted. It has been put through Parliament for first reading. And clearly there's an expanded scope of services and it will inadvertently have impact on this community. Don't forget that, just prior to this, there were also other consultation papers that have been issued. The Omnibus Act, for instance, which impacts activities done by Singapore companies outside of Singapore. So when you overlay against the PSA, the Omnibus Act, these amendments, one thing's for sure, there is no risk when it comes to regulatory development in the blockchain space. Let me move on. No, you will, as if you've been to our previous webinars, you know that we try to make it interactive. So we're going to have polls just to get people, moving their fingers so you don't fall asleep so quickly. So the first poll question is this, Kevin, please get ready. Tell us about your profile and interest in this webinar. Kevin, are you there? We have lost our host. Okay, no worries. We'll get back to this in a bit. Sorry, this wasn't planned. Okay. Oh, Kevin, you're back. Are we ready to execute the poll? Never mind, Kevin.
Okay, sorry. Yep, I'm going to start the poll right now.
Okay.
Okay, started.
So this asks about your profile, whether you're exchange, whether you are in payment space, your crypto-related company, or other financial services company. So if you can vote. It takes some time for the voting to get through, but this gives you a flavor of what to expect. Kevin, are the results out yet?
Yes, I'm going to close it. 3, 2, 1. Okay, I'm going to share the results. There you have it.
Okay, quite a nice spread. Exchanges, other payment firms, other blockchain-related companies, other financial services companies. So that's a nice spread. So good. Looks like we're all vested then to understand more about the impact of the PSA. So let's move on. Just a bit of background. Now, you might be asking, why is the MES expanding the scope of the PSA to cover more activities for cryptos? It seems that the crypto space, you could argue that, even for securities, you're just dealing in securities, you have an exchange and securities derivatives, that's an advisory. However, in the crypto space, there are multiple categories of activities relating to cryptos. A lot of it has to do with AML and CFT concerns. So the FATF has issued a paper on VASPs. Actually, more recently, they issued a red flags report on virtual assets. We had a webinar on that previously as well. So a lot of it is to align Singapore's position with the expectations of the MES, of the FATF. The question is whether we are trying a little bit hard, or some might say even too hard. Well, that's for the debate is up there, but really the view that has been taken by the regulators is that cryptos carries money laundering and terrorist financing risks because of the anonymity of transactions. Again, that's debatable given the nature of the blockchain, the speed of transactions, and the cross-border nature of transactions. So that's really why they have done what they have done. Now, just a bit of a recap. And these are the different, the 7 different regulated activities under the PSA. What these round of changes will impact would largely be 6. So there's 7 as well for money. Sorry, not 7 for cross-border money transfers, which is 3. But really, we're focusing on 6 today. Now we know that the PSA already covers dealing in digital payment tokens. It covers exchanges. So we've got some of the crypto exchanges here as well in the panel. What the amendments will seek to introduce is to introduce 3 additional activities: transfers of cryptos, custodial wallets for DPTs, and facilitating exchange of DPT without possession. So a little bit more about the definitions in a bit. So these are the 3 definitions. Now, what are the implications? The implications is that if you fall within these regulated activities, you are obviously subject to licensing under the PSA, right? You need to apply for the license like everybody else, and you will be subject to AML and CFT requirements and other requirements also. Okay, let's move on. The other non-crypto related expansion of the PSA is that they've expanded the concept of money transfer services to include services where you facilitate a movement of funds in different countries, even though you don't touch the money. So nothing touches Singapore. So you facilitate a transfer of monies from country B to country C, but you are in Singapore, that will be a licensable activity, and you are also subject to AML and CFT requirements. So that's an expansion as well. Now, I think the MES is already very powerful. We all know that. However, these amendments actually seeks to give more superhero powers to the regulators. So there will be user protection measures on DPT providers to safeguard against customer assets. Just a little pause here. You would note that in earlier iterations, the MES's focus for crypto was really AML, 99%, and maybe 1% DRM, and no user protection. So that was very explicit by the MES earlier on. They now have vested themselves with these powers to include user protection measures on DPT providers. So what are these user protection measures? We'll talk about that in a bit, but it largely mirrors the user protection measures for other activities like e-wallets, all your fiat e-wallets, and even money changing. And then the MES also includes a power to set up measures which are necessary or expedient in the public interest for financial stability or monetary policy. Now, this probably is a signal that the crypto industry is growing, and it's necessary to have these financial stability kind of powers which exists for other traditional asset classes, right? So the MES actually mentioned that the rationale for this is the growth of the DPT sector, including stablecoins, which could have a more widespread impact in the traditional economy as we know it. There are other miscellaneous amendments as well. I'm just giving you a quick overview now. The MES can prescribe other types of licensees that must safeguard customer monies, other PSA license holders. So that power is now there. It includes, it also has amended the PSA to broaden the scope of domestic money transfers to include situations where the payer or the payee is an FI, a financial institution. And there's a general duty of care not to furnish the MES with false information. That now applies to all persons, whether or not you're an individual. It includes companies. That makes it quite stark that if you misrepresent something to the MES, that becomes a criminal offense right now. Now, next poll question. How materially do you think these changes will impact on yourself? So, Kevin, poll master. So the options are major impact, 2, somewhat impacted but able to be mitigated, 3, minimal or not impacted at all. So your votes in right now.
Wow. So there are folks that are not not impacted. Very happy for them.
Are we going to stop the count now?
Yes. 3, 2, 1. So stop right now. Share the results. There you go.
Somewhat impacted would be the majority, but able to be mitigated. Major impact, yeah, quite a sizable population as well. Okay, interesting. Okay, let's move on then. As long as nobody's going to challenge these voting outcomes in a court of law. Okay. Now, so these are the measures that applies to crypto exchanges or a DPT service provider in generally. So these are the user protection measures that I mentioned. Just a quick recap. You would know that for, let's say, if you have an e-wallet and you're a major payment institutions, account issuance and e-money issuance, typically the user protection measures would require you to ring fence the customer assets such that in the event of insolvency of the payment firm or the bank, so these assets will be protected. So the bank has to either set up a trust account or guarantee. So the whole rationale is we want to make sure that customer assets are protected. So if they're remittance, they should be sent to the beneficiaries. If not, they'll be returned to the customer. So what is the parallel when it comes to DPT services? So these are the powers that the MES has inserted in the bill, anti-commingling measures. So the DPT service providers must segregate customer assets from their own assets. So the customer Bitcoins are, put in a separate account. There is a need to ring fence customer assets to protect them from claims of other creditors. in the event of licensee's insolvency. So this is interesting. So you need to create a legal structure, maybe a trust structure. So that's something you need to consider. Maintenance of customer assets and licensee's assets in a prescribed manner. For instance, maintaining certain percentages in whether in cold wallets or hot wallets. Remember, this applies to both the customer assets as well as the licensee's own assets. So this is quite interesting. You don't see this for the other activities. But I think talking to the exchanges, some, in fact, I would say most exchanges have some policy where you would put, crypto assets in hot or cold wallets. Also, there would be an internal policy. Okay, now we move on. The bill actually stipulates a few other additional requirements. First, the need to have insurance to protect against the risk or to mitigate against the risk of the insolvency of licensee. So this is quite new. So I think the panel has got some strong views on this. We hear from them in a bit. The need to protect data of customers. So this is again explicitly new. I mean, it's new in the sense that it's explicit. It's not surprising because we have got PDPA, but this means that when you factor in your compliance program, you need to have these considerations as well. Third, you need to monitor DPT accounts and customers. We hear from Regang later on whether right tax solutions can do this. And next, you must make certain disclosures to customers. And these there's some stipulations on what these disclosures are. So these are new requirements. These are interesting. So we can have a debate about that in a bit. But I think we will jump to the next poll question. Just a very quick sensing from the audience. What do you think of these user protection measures? Kevin, can we run the poll?
Okay. Launching it right now. And okay.
Okay. First option, very much needed. Next option, current policies should have already been sufficient. Third option, added cost to service providers, and this will impact to the industry. Last one, not sufficient. There should be stricter policies. Actually, what's missing is this. So when you look at the other exchanges, right, like securities exchanges, they will have very strict requirements on anti-market rigging, anti-manipulation, insider trading, front running. So these are not don't quite address those yet. But let's see your thoughts.
Okay, a couple of folks are still going on it. Okay, it's gonna end this 3, 2. Okay, I think still people. I mean, there are people still recording it, going on it. Just one more. Okay, ending it 5, 4, 3, 2, 1. Okay, sharing the results.
Okay. I think almost majority view is that it's very much needed. I think there are probably a lot of people who use crypto exchanges. Current policy is a small percentage, and there's also quite a sizable 30% think that there will be added cost to the industry, which is correct probably, and about 9% not sufficient. There should be stricter policies. Okay, we can have an interesting debate about this during the panel discussion, and you can shoot your questions and thoughts as well. Okay, now let's go a slightly deeper dive into the specific definitions. So the MES has published a response document to the consultation paper. So typically this is how the MES does its job, right? There will be a policy consultation, and then they will take in comments. So we ran an event in January for this. So we submitted our comments. The MES will typically, before they publish the bill, they will have a response document. That is a very important document. So my advice to everybody is please go and read it carefully, because it states the MES position, policy position on a lot of things. So whether it's on this PS Act or for other legislation, please read that. Now during the consultation period, there were comments that this whole concept of trying to regulate active facilitation of DPTs is so broad, and it could catch activities like marketing or advertising, because it could be argued that it's facilitating DPT transactions. Now, MES clarified that the intent is to catch entities that carries on the business of actively facilitating buying or selling of DPTs. whether or not they touch the money. So possession is irrelevant. So long as I nudge you or I instigate somebody to buy or sell cryptos, I am caught. So these could be brokerage or exchange services, or applications which matches buyers and sellers without possession of money. So it's irrelevant whether the crypto touches your platform. So long as I match, let's say Azman sells cryptos to Mrigang, and I match it, I need to be licensed. Whether or not, so the cryptos could go through directly from Azman to Mrigang. It doesn't matter. But they clarified that general marketing and advertising activities are not caught. Again, there's a very careful caveat, depending on the facts and circumstances of the case. A lawyer probably drafted that. But the MES at the same time very quickly says that, note that we have a prohibition against soliciting customers unless you are a licensed or exempt entity. So in fact, it might be difficult for you to advertise because you need a license before you can solicit cryptos anyway. So that is the whole concept of active facilitation of DPTs. This is a separate activity from dealing. The MES has said that these are distinct. We can debate whether it is or not. But this is quite unique for cryptos. There isn't, in the SFA, it's just dealing in securities or dealing in capital markets products. It doesn't like slice it between dealing and as well as active facilitation. Okay, next, transfer of DPTs. Again, this is quite crypto specific. So if you facilitate the transfer of DPTs, you need to be licensed. So there was a clarification that was sought. How about technical activities like blockchain mining or software development? Is this arranging for the transfer of DPTs? Because the way it's worded, it could be interpreted very broadly. The MES's response was that it does not seek to regulate entities that are involved in these technical activities. I assume technical means linked to technology. The scope is that it applies for any entity providing the service in Singapore, even if your systems are outside of Singapore. So long as you are physically in Singapore, you have a Singapore company, you're caught. And when you transfer the DPTs, you need to abide by the travel rule. So these are the requirements, remember, where you have to share who the sender, beneficiary information, and some details on these parties to the next intermediary. So this is transfer of DPTs. The next, custodial wallets. Now remember that the proposal is not to regulate every crypto wallet. Okay, just a bit to recap. If it's a fiat e-wallet, it's already caught under account issuance, and of course, if an e-money issuance, if you have e-money. Crypto wallets per se, before this, was not regulated, and non-custodial crypto wallets would still remain unregulated. So this proposal only captures custodial wallets. And for custodial wallets, how they demarcate this is that the concept of control over a wallet is important. Now, during the consultation papers, I think we had very lively debate when we ran the roundtable as well. People were asking, how do you determine control? How do you distinguish between possession and control? And then if you carry out something in accordance to a customer's instructions, is that still control? And how about miners and validators? So the MES clarified, I don't think they squarely address all the questions, but this is how they define it. Control means the ability to control, access, or execute any transaction on the wallet. So you are caught within the scope if there's control over the DPT instrument. For instance, if you have access or you hold the private key. And so it doesn't need to be exclusive. So if you are, if the key is sharded and there are 3 smaller keys and you hold one of it, that's still a custodial function. So even if it's not the entire key. But they've clarified that the intention is not to regulate activities like mining or, if you validate, if you're a validator node. So that would give some comfort. So that's custodial wallets for you. And then the MES also gave some further clarification. What if you have a wallet that holds both cryptos and fiat? The response is you need to apply for all the different activities like DPT services that addresses the custodial wallet element of it, account issuance and e-money that looks at the fiat aspects of it. How about securities tokens? There are more of these wallets up. The MES's response is you need to apply for both licenses under the SFA and the PSA. That's a default position. There is an exemption under the SFA where if your payment activities is solely incidental or necessary for the SFA activity. So it's to borrow the MES's term, dependent on the facts and circumstances. Obviously, if you provide a service that can custodize all securities tokens and BTCs, ETH, it might be hard to run the argument that this is solely incidental because these are different asset classes. So you need to look at the factual matrix to make a determination. Okay. In relation to token issuance, so this is not regulated activity in itself. It's not a separate classification. That's what I mean. But the MES issued some guidance in the reply to the consultation document that any entity that buys or sells cryptos, including its own cryptos. So that means if I'm the issuer, I sell my cryptos and I get either fiat or BTCs or ETH or other cryptos, that's a licensable activity. Now, this means that as a matter of default, most token issuances needs to be licensed, unless, of course, you argue that the tokens are limited purpose DPTs, and therefore they are not DPTs, or they're exempt from the PSA. But by default, this is licensable. And this might be a little bit troubling because I remember we had a session in a webinar that was hosted with the MES there, and they clarified that if it's a one-off token issuance, it's not likely to be treated as a licensable activity. However, that's not in writing anywhere. So this is an area that I think could potentially impact on the whole token issuance activity in Singapore. So unless you, of course, work with a licensed intermediary like an exchange or someone who's got a DPT license, then that's theoretically possible. But this could have an impact on token issuers and token issuing platforms. So what does it mean going forward? Going forward, there is a transitional arrangement, like most new activities that are regulated by the MES, of a period of 6 months. So if you were previously, let's say you were in the business of running a custodial wallet, you were not regulated for anything, and then so you need to be regulated. So you have 6 months exemption period. Or similarly, let's say if you're an exchange, you were previously not, but you still had a custodial wallet business, but you were not, obviously you were not licensed for that, you would also have 6 months. The details will be, the subject of a separate consultation. So people are asking, so is this law, is it not going to be law? When is it going to be implemented? So how it works in Parliament is there will be a first reading. So first reading has taken place. First reading really means that they introduce this big chunk of materials to the Parliament, the amendment bill, as well as the explanatory statement. There's no debate yet. It will go through a debate. That's the second reading, which typically takes place at the second time Parliament is being convened. And third reading is, where it is passed by Parliament and it will then receive the presidential assent. Then it becomes law. But even if it becomes law, let's say it becomes law in January, it doesn't mean that it will be implemented. When the trigger will be pulled depends on the MES or the minister in charge of MES. So there will be some form of a gazette notification to say that by a certain date, this will be implemented. And if there's a need to issue out any regulations, it will be done during that period before the implementation date. So that's where we are. So now remember, so for the DPT user protection measures, it's just there in law. It doesn't mean that it will be implemented, because the way the act was drafted, it has to be prescribed by way of regulations before it gets implemented. So MES needs to issue regulations to say that we are now, implementing the user protection measures. These are the more specific requirements. So that broadly is how it works. Okay. So last poll question before we get to the panel discussion. Do you think these changes will be positive for Singapore? Let's hear your thoughts. Poll master. Kevin? Kevin, you there? You seem frozen.
Yes, I'm here. Okay, there's some technical difficulties. The number 4 didn't come up for some strange reason. Sorry, you can't do the poll number 4. Sorry about that.
Okay, yeah, let's see whether we can get it fixed.
Yeah, later on we.
Yeah, for the panel.
Yep.
So that brings us to the panel discussion. So yep, I will finish my presentation. Will hand you over back to Kevin.
Thank you so very much. And I think let's start quickly with the panel. Certain questions I think the public will be interested as well. Now, the first question, I think this is open to.
Hang on, Kevin. I think you should introduce the panel members first.
So sorry, I didn't do that. Right. So with me, I mean, definitely I'm moderating this panel. With me, I think you have already heard Nizam. He's the head of the Regulatory and Compliance Subcommittee of BAS. Then next one is actually Thomas Mahon from Air Carbon Exchange. He's the head of the Digital Exchange Subcommittee as well. Then we have Branson, board member of BAS and also a member of the Digital Exchange Association because he's actually running Exchange ECXX. Then we have Mrigang from Merkel Science. Merkel Science is actually one of the Regulatory and Compliance member as well in the subcom. So there we have, this is the panel, and I think let's start with that. Very quickly, we will want to go through some of the questions I think the panel will be very interested to answer. So I think there's a discussion of insurance, right? In the section 21A about insurance against insolvency of licensee. Now this, of course, add cost to the whole process and of course, even the question, right? Would insurance companies even take on such a risk? Because it could be an unlimited liability kind of situation, right? For insurance company. So what do the exchanges think, right? What are your thoughts on this?
I'll take a stab at that. Actually, I wouldn't know one insurance company that would write a policy today. We've been doing our board formation on air carbon and just seeking directors insurance. And there's nobody writing that in Singapore now, simply because of just, the risk and a lot of insolvencies and things like that. So I'm not quite sure. I know that MAS wouldn't do this in isolation, so I'm sure there's some conversation going on somewhere around this in terms of who potentially would be a provider, but I don't see any clarity on it, and it'd be very interesting to see it. I've set up traditional markets architectures and where we've gotten insurance wrappers around the clearing default mechanisms on the exchange, and it doesn't come cheap. But again, it's a very limited offering too, and who would actually be in that space. So it'll be interesting. Love to see it develop if it potentially could. It'd just be an additional value and protections and give ultimately investors comfort. But it's definitely an open question as to who would provide it. Right.
Branson?
Yeah. I think I share the same sentiments as Thomas. I think at the end of the day, if you look at the spirit of why MES is doing this, I think it's good. It's basically to protect, the users, right? But of course, the question then is, what's on the other side, right? And to Thomas's point, essentially, I mean, there are one or two that I've heard of, but I think the other question is, if we're going to insure the assets or even the entire operations, how much does it cost, right? And obviously, it depends on how big your operation is or how big your exchange is, and I presume it's not going to be cheap, right? So these are some of the I guess considerations that we have to be mindful of. Yeah.
Okay. And finally, to Asman from Upbit, representing Upbit Exchange. Asman, for your thoughts as well.
Yeah, I mean, I would agree, obviously, with the panelists in terms of the costs and adding on to the cost of that. But I think we need to look into this entire, user protection. Clearly from the fact that it's you're supposed to implement, and I'm very curious about what MAS regulation will look like. Come next year, in terms of once they will prescribe some of the controls and monitoring that's required in order to ensure that the customer's assets are fully segregated. So the point being is, like, you want to protect the user's assets. And obviously there's a lot of measures that we're going to put in place, not only from the company's the segregation of the assets from the company's assets to prevent from the risks of creditors' claim and also insolvency, but also, in terms of, the monitoring as well. So I wonder, in terms of to what extent that the contingent liability of having an insurance would add other than costs. So it's a very interesting question, clearly, but we'll have to see what MAS will put forward sometime next year.
Okay. Thank you very much.
I think to add on, I think it also depends on what the expectations are, because when you talk about insurance, it could extend from professional indemnity, directors insurance, or are we talking about insurance against fraud, or is it insurance? Are you protecting all the assets of the customers, or is it something else? And I think it can be quite a daunting task for the insurer, right? Because if you want the insurer to undertake to underwrite all the entire assets, that could be a humongous amount of assets to protect. So it really depends on what the regulatory expectations are. So I think actually I think it'll be good if there can be a consultation before the specific user protection measures are actually being introduced for exchanges or DPT service providers.
I had a distinct experience, if I may add to that, with having a discussion with an insurance broker regarding DNO, directors and obligation and liability insurance. And he clearly pointed out there's obviously not many appetite out there, risk appetite among insurers to insure crypto businesses.
Yeah.
And therefore the remaining few who's obviously happy to put up their head, will charge a huge premium. So I think these are some of the consideration that MAS maybe should look at together with the insurance industry. And maybe perhaps we can, address it in a more efficient fashion. And I do applaud the fact that you want to protect the customer's assets, but we also at the same time have to look in terms of the businesses themselves and not add on unnecessarily to the cost.
Yeah, and if I may add as well, the whole idea is that everything is built on code, right? So and we have seen that there are a lot of software code is always buggy and things like that. There's always improvements. Just for discussion's sake, even operating system like Microsoft and things like that, there are still patches and things like that. So the question is, how far do we go, and do we need to involve the audits of code and things like that? So that's another thing. Yeah.
Okay, so there's this comment from the audience that they mentioned that one way is to have fortress reserves, right? So I'm not sure if anyone will comment on that.
I assume you're talking about like a default fund methodology, or
like an in-house fund. I think that's what the fortress.
Yeah.
Yep.
I mean, almost a self-funded default fund.
So a lot of the bigger exchanges actually do that, right? They
sure.
have a fortress reserve, and I think customers feel safer going to those that are insured as well. So at least looking from an outsider's perspective, the MAS might have brought it about right now, but it was only a matter of time before this was going to be one of the criterias for exchanges going ahead as well, I think.
Yeah, I agree with him, McGraw. I mean, we're doing that because we don't have a traditional clearing model, so we don't have a traditional CCP default fund methodology, but we're going to build a default fund structure, which is kind of unique. But the Binances of the world and stuff have large reserves, and they cleave it off in fractional pieces. Every time there's a transaction, they put a piece into the default fund. But if you're not an exchange, if you're just a payment provider, you're not going to have that default fund methodology. Right. I mean, so putting insurance in that in that space is sounds good. I think it's easier said than done though at the moment. So
okay. There's another comment being added from the audience that he believes that there's one where Lloyd's of London up to 500 million, but they would want to know the operations and safeguarding a customer and specific components. So I think there's a comment on that. So anyone want to discuss that, right, about this Lloyd's of London insurance? Okay, probably not. So
send us the agent's name.
Well, and also the scope of it.
Yeah, absolutely.
Oh, that'll be interesting. So well, whoever kind of put this up, feel free to put it up on the chat group. I think there'll be many interested parties that want to know about this information.
Yeah.
Okay. So before we move on to the next question, managed to get the poll set up and running. So I'm going to launch the poll for the fourth poll. Right. Do you think these changes will be positive for Singapore? Wow, quick. Okay, 5, 4, 3, 2, 1. Ending the poll and sharing the results. Ah, very interesting. Seems like people have confidence in MES doing this for the better good of everyone. Okay, I'm going to stop sharing the results and go on to very quickly the next question. Okay, so I think one question that rises up from some of the statement and amendments that MES actually written is that it is stated that MES reserve the right to impose measures on individual institutions, right? That was this very vague statement that say, okay, if they find that it's not up to speed or whatever, they could actually implement measures particularly targeted at individual institutions under the PSA. Now, would anyone want to comment on that? How would you feel? Do you feel something that's quite rather threatening, or something that really sense as a warning? And because it's vague, you don't know what measures they would want you to implement. So how do you feel about that? Yeah. So this is open. So whoever wants to answer it first.
It's a loaded question. I think targeted may sound threatening, but I think actually it may be better in the long run. That if they see weak links in a broader industry, as opposed to trying to put a blanket change, I think if they can selectively or supportively correct deficiencies, I think it might be okay. I think it actually might be quite different than how they operate today.
If I may add to that, Tom, I think obviously we are starting up from a very different playing field. I think what MES is trying to do is harmonize some sort of standards, and clearly there are people who are more compliant than others.
Yeah.
Perhaps some sort of targeted, measures could be, in a longer term, more preferable and more judicious and fair, rather than having a blanket one. So therefore, the fault of one doesn't impact everybody else in the industry.
Yeah.
But there's a hope, obviously. But it remains to be seen in terms of the details. It's always the devil's in the details.
Yeah, I mean, just to chime in, I think to be fair, I mean, this whole space is still very, very new. I think a lot of things are still, being worked out as we speak. So I guess, I mean, I can only guess that, this is obviously targeted at, specific regulations as things, happen in the space. Yeah.
Okay. If no more comments, we move on to the next one, an interesting one. Especially we talk about something that's very popular among everyone, USDT, right? So with the enhanced rules and all that, and what do you think will be MES response to the treatment of USDT? Because I think various providers have actually asked this question on MES, right? Because under the current, I think the treatment of stable coins, they are treated as e-money, but arguably USDT is not exactly pegged to the dollar, it's pegged to a pool of resources, right? So arguably it's not e-money. So what do you think that they will respond, and what should be the correct response to treat USDT? Is it going to be really a stable coin right under e-money, or should it really be a DPT, which is essentially what is actually being used for right now?
Yes. I think if I may comment, because we did explicitly made a representation to MAS regarding this point on USDT, whether or not it can be considered e-money or versus a stable versus a DPT, or obviously dividends under the SFA. we made the representation exactly due to the fact that the definition of e-money today that is being equated to stablecoin is not exactly very precise. We feel that stablecoin should have its own subsection, its own set of regulation, because the way it operates is quite different from e-money per se, like obviously like a cash card that we use for MRT and for those type of purposes. Here we are looking at an entirely different set of regulation, because obviously it's hard-coded, and the way that it's being monitored and controlled is obviously within the technology itself. So the solution, we feel that should be part of the technology, and therefore a subset of a stablecoin regulation perhaps is more welcome in that sense. So that's some of the representation that we made to MAS, and as yet we have not heard anything back. So it remains open, but it's clearly an area which requires a lot of consideration. And obviously, they see the importance of stablecoins, and I think, and I hope that they would treat that separately from e-money. That was the representation that we made to MAS. I wonder whether anybody else has a different view or representation made to the MAS as well.
Yep. Probably Branson, I think you mentioned about that. You have also represented about USDT as well. Maybe your experience on that.
Yeah, sure. So I think we had the same. We made the same representation. Essentially, it's difficult to classify it as e-money, but at the same time, I'm not sure. Again, this is just my thoughts, right? My personal thoughts. I'm not sure whether the current ongoing, lawsuit with USDT or iFinix or the parent company has anything to do with this, and therefore, there's a bit of delay in terms of the actual stand as to what USDT is. Yeah, I can only guess on that part, but overall I think we made the same representation to MAS. Yeah.
Okay. So Thomas and Nizam, any comment on that? And I think there's a question coming up from, I think probably I just must see, there's a comment question from the audience. So you talk about USDT, right? So the question is, what about USDC and the various variation of the USD token? What do you think about that?
We haven't ventured down that road yet, truthfully. From our perspective, we're still trying to master the art of getting fiat custody and US dollar settlement transactions clarified. Clearly, the stablecoin environment, I think, going forward, and as you move into the digital currency space in a broader at national level, if we get that far, I think it's going to have, this whole thing's got to be revisited in a very short order. If China puts out a digital renminbi, does it get captured under MAS regulations, right? I mean,
there's an exemption for central bank currencies. There's a specific exemption for that.
Ah, okay. I was not aware of that, but yeah. So for me, yeah, I haven't truthfully, I haven't pushed into the USDT issue.
I think my thoughts on this, Kevin, is that as with most things in life, there are always different shades of gray, right? And it really depends on how you slice the risk that you see for everybody. There are currencies that are pegged on a fiat currency, and then there's another model where the actual fiat is put in a bank account somewhere, and you claim it's audited and all that, and it's a one-to-one, in theory at least, it's a one-to-one match. And then you see from the regulator's perspective, when you talk about e-money in Singapore terms, I think the first e-money was probably your MRT card, right? I mean, that was the first, and typically the worry is always user protection. That when I put $10 in my MRT card, I really want to make sure that there's actually $10 kept somewhere in a float, and therefore if something happens, I can actually get a refund from my card. So that's really the key concern. However, I think maybe what regulators don't appreciate enough is that when you buy a USDT, USDC, or some of these other fiat-backed stablecoins, I think the psyche of the person buying it will probably be a bit different, right? These are probably the people who buy BTCs or ETH and probably want to park the value of their investment, now that BTC has gone up so high. So I'll exit and park it on USDT. So it's a different psyche, and I think the risks are also, and people know that, it's the level of regulatory protection isn't going to be perfect for USDC, USDT, or, some of the other fiat. So it's a very different psyche. And to impose a cap, an account cap for e-money of $5,000 per account is not going to be workable if it's e-money, or $30,000. It's going to, crush the entire, fiat-backed DPT industry in Singapore and affecting all the exchanges. So that's something that I think we've made this point previously to the MES. I think they need to come back and review the policy position quickly, because the thinking is that this would impact the banks, right? Because if you run a debit card, you're a very big payment institution. People are not going to use the banks anymore. They're just going to park in the assets with the debit card or the e-money float. But so that is a policy consideration. But it's not the same consideration for people trading fiat-backed stable coins on exchanges. It's very distinct. So I think that's something the MES needs to get back and resolve very, very, very quickly.
Yeah, and maybe I just want to add another point, right? So stable coin, besides what Nizam has just mentioned, being backed one-to-one with your reserves in the bank or a basket of currencies or whatever, there's also another class, right, which is algorithmically packed, like DAI and things like that. I'm not sure whether MES has a position on that as well. I'm not sure. Yeah,
absolutely. And there could be gold-backed or other commodities-backed tokens,
and
intangible commodities.
Even from a treatment perspective, there's a lot of questions about the different types of stable coins, right? So I think, I'm not sure if they can be categorized into the same category as well. Like USDC is fully regulated in the US. So that might need to have a slightly different bucket, like based on what they peg it at. Like if it's pegged on something like gold versus like if it's the equivalent of DAI, which is not pegged to a fixed asset, or if it's like a stable coin that's pegged to virtual assets. So I think different approaches might have to be taken depending on the type of stable coin, rather than a whole bucket of rules for each and every type of stable coin. And especially from a consumer protection perspective, because some actually have a very high inherent risk as compared to other models of stable coins.
Okay, thank you. I think we have answered most of the questions on stablecoin and all that. So I think probably that's something to really engage with MES. I think given that you have exchanges who have actually sent a response to MES, we haven't really gotten a reply from them. And so one of the things that I think as BAS, as an industrial association endorsed and recognized by MES, we are going to engage MES with all this, very certainty in terms of getting certain certainty from MES as an association, especially coming from having two subcoms that represent the industry. We will help the industry to actually get a certain clarity. And this, whatever we discussed today, is not something that one of those webinars where thank you very much, and after tomorrow you forget about it. No, this is something we are recording down. We are bringing it into MES to share this is a concern from the industry. So just to share note that your participation is very important, right? As an audience, your questions are all recorded, and we will actually compile. And then, when we engage with MES directly, we will be focusing on these concerns. Yep, just a short interim. Okay, next question. And I think this is something that Nizam actually had presented just now in the slides with regards to token issuance, right? So let's say, for instance, the MES treatment about, if you're a token issuer itself only, do you need to be regulated? Do you need to have a license? Now, I want to tie it back because I think there's a question from the audience that, does a token issuer issuing on a license issuing platform itself need a license since they are the token issuing originator? So that ties back to what Nizam presents. So probably Nizam, you could start this answer on this.
Yeah, I'm a little troubled by it because reading the MES response document, it seems that yes, the token issuer needs to be licensed, because if you buy and sell your own token, and even if you use a platform, there would be a mechanism where you as the issuer needs to sell the tokens, right? Because you are the legal entity selling the token, so you are selling and you're getting something else in return, whether it's fiat or BTC or ETH, whatever the consideration is. So even if you use a platform, technically there's an argument to say that you still need to be licensed, but I think that might be a bit limiting, because if you use the parallel of in the securities world, say I'm a telco, I'm Singtel, I want to issue shares on the SGX. Yes, I will have a broker dealer. It could be a broker dealer that would advise me or would be issuing my shares, but I don't need to be licensed. Why should I? I'm just an issuer. I'm issuing the securities. So there's some parallels that suggest that issuers, they should not generally be treated as a financial intermediary. Financial regulations should predominantly look at the intermediary. So that would be my preferred approach. And I think when we had a previous webinar, actually it was hosted by BAS as well, on the PSA with the MES. The MES did say that they would look at a one-off issuance of tokens to be not in the business of, in DPT services, and therefore that would be okay, in that you don't need a license. So again, it's not entirely clear, because the latest written response by the MES seems to suggest that you need a license. So I'm really not certain what the position is, and I think it's an issue that we probably should get clarity from the regulators on.
Any add-ons from the rest?
Yeah, I think going on the back of Nizam's point, because you don't have a traditional broker-dealer model here, or a bank, right? A bank that's going to be the issuer of the token, and that's where you've got basically direct market access to be an issuer. I think that's really where the question mark is today. Yeah. So it's really a shift in the infrastructure that sort of leaves it vulnerable on the licensed entity. Yeah.
Yeah, and in the Singtel example that Nizam mentioned as well, like there is an intermediary that is like licensed, so consumer protection is taken care of. But
right.
I think I agree with Tom that, like, at least here, since there are direct to consumer sort of paths, that the considerations might be slightly different. Where I think the AML considerations or even the user protection considerations is why there may be an argument why it could fall within a licensing regime because of that, because they don't have to go through an intermediary. Or,
yeah.
I mean, I know that it increases costs, obviously, but like the other way around would probably be that there needs to be certain intermediaries through which tokens can be issued, and no direct intermediaries as such. So I think, but again, that is very difficult to, I guess, implement in our industry. So I think that's where according to me, I think that's where it does make sense to at least like club token issuers within the same category as those requiring a license.
Yeah.
Yep. And I think just to kind of like add some complexity to the whole conversation is that I mean, there have been claims by certain projects that actually say that they are kind of like regulated, and they are actually DeFi projects, right? But the thing is that the claims is that they are regulated. So I guess probably they're using this particular item to say that they go via a licensed entity, right? A licensed platform, whatever you call it, right? To actually issue the token, right? But the thing is that it goes beyond that, because the whole spirit of the DeFi is that it is not just you issue the token, it stays there and does nothing, because you actually get the token being circulated, you get it exchanged by other digital tokens like Ethereum or Bitcoin and all that. So this becomes very murky because there's no clear regulations on how to actually even treat DeFi right now, right, from the regulators. So, there are exchanges in this panel. There are also, compliance in this panel as well. And I think in the previous webinar where I think Nizam was actually, presenting about, the treatment of DeFi. So maybe it's something we can revisit from, this conversation today to ties in about token issuance in the particular case of DeFi. Now, what do you think should be the case to actually treat this, right? Given that this is something that you can no longer avoid. People are doing more about that, and even in Singapore, where we have the PSA to regulate it, and there are already claims by certain projects that they are regulated, right? So what's your thoughts on this? So maybe Nizam could kick it off, since you had.
I think it would hasten the need for clarity on this, right? Because in a DeFi project there will be a token issuance typically, and therefore the question is whether you need to be licensed or not. And of course, you could argue that if it's a one-off thing, you're not in the service of, conducting a DPT service, whether it's facilitating or whatever it is, or dealing. So clarity is important, particularly if you want to catch or you want to encourage good DeFi projects to be issued out of Singapore. And I think it's a massive space for that. Yeah, and then of course, as the other dimension apart from the token issuance regulatory treatment is whether the project itself needs to be regulated in light of and that's inherent in the characteristics of the DeFi project, whether it's, for instance, it falls within, it has elements where you could say that it facilitates the transfer of DPTs, or it provides some element of a custodial wallet. So that could add on the complexities of a DeFi project. So you need to really understand the underlying economics to see whether it triggers off any of the PSA licensing requirements.
Yeah, I mean, let's take the point that if a token, a DeFi token out there is requiring license, my question is obviously, because the nature of the DeFi token itself, how do you comply with some of this regulation under PSN 02 with AML requiring, obviously a full KYC to be done on those holders? And of course, when you do the transfers as well, how do you comply with the travel rule and so on and so forth, because of the very nature of a DeFi regulation? So it obviously will cater towards a very interesting space in terms of how the regulators would treat that kind of a model, which is quite different. I mean, but I think it's very difficult to basically cut and paste the current regulation dealing with DPTs and other types of token into the DeFi space. So it requires a different kinds of consideration, I believe, because you obviously need to look into obviously the coding and the technology behind it. Perhaps even maybe auditing the codes. I'm not quite sure. I mean, obviously there are obvious people out there maybe perhaps looking into this, but clearly it's an area of space that MAS needs to address. I'm very curious how they will deal with this.
Right. Okay. So I think there's a question that ties in again with this interesting topic about token issuance and all that. So I think we are talking about, digital assets. Obviously, there's a certain value, but the question is that if token issuance is essential as part of the technical stack, like for instance, the compounds, CUSDC, AAVEs, AUSDC, and all that. So would that, the question from the audience, that would license be required for things like that? Yep. It is a technical nature, I think, in terms of they are issuing the token because it's technically required, right, to operate a platform, right, to do certain things. Now, would that be required to actually have a license for that?
I think it's coming back to the same question, which is, how do you even start to regulate such activity or even actors, right? Because, I mean, coming back to Azman's point, if I were to launch a project and it's a DAO, right, decentralized autonomous organization, then who do you go after? The person who write the code, or and if let's say there are 20 persons writing the code, how do you apportion the the responsibility to who, right? I think that's the biggest question now. How do you regulate a space that is intended in the first place to be decentralized? Yeah.
Okay. Just a bit on the decentralized, since we are talking about that as well, right? About the tokens and all that. So there are certain decentralized exchange like, Kyber, that was previously under the so-called express exemption, but it does appear with broadening of the regulatory provisions and as of the amendments under the PSA, right? Then becomes companies like Kyber and local Bitcoins, they may have to review the position, right? Because they are facilitating the exchange of DPTs without the possession of the DPT. And this potentially ties in with what we want to discuss in another question as well, is that, becomes the OTC broker, the market makers and liquidity providers, right? Who not necessarily have possession of DPT. They are brokers, they are just facilitating the trade. But it seems to then that this providers and all that will then be potentially have to be regulated under the PSA, especially under the amendments. So what do you think about that? Because it seems like then it's a very wide net, as as a very broad net that is going to be cast and is going to cover everyone going forward. So what does it mean for industry? How does it affect everyone else? Is it a fair statement and all that? So probably hope that the panel can comment.
I mean, I think it's fair in the intent if you go to the highest level of where we began this conversation for FATF and such. But the industry is still very nascent, right? We're imposing regulatory frameworks that are traditionally being imposed on multinational financial institutions, right? Mature banking infrastructure and mature exchange spaces, and it's being brought down. And that doesn't mean it's wrong, but it's really going to be it's going to make it very difficult for the industry to raise its head up or be very organic. The parts of the current financial industry for people to do those same jobs is not regulated. I can be an intermediary in an OTC transaction around commodities, and I don't have to report to anyone. But clearly, the bank movements are going to be reported and stuff, but that's not on me. I'm a middleman, right? I take my 2% out of it or whatever it is. So it's very interesting that we're getting into this micromanagement of entities never actually taking possession of the underlying assets, just being a facilitator. And I do respect that in terms of traceability or money movements from the AML perspective, but it really becomes very much a blocking mechanism in terms of how you can actually grow the business, right? So there's a good side of it, and I understand the good side of it, but also, again, the industry is still fairly nascent. It's going to create a lot of friction, I guess, is a better way to put it.
Yeah, I think my thoughts would be similar to Tom said, but I think more importantly would be, so to protect the users and things like that, I think this is good. But on the other hand, what's stopping me, let's say, if let's say local Bitcoins are banned in Singapore because they couldn't get a license, what's stopping me from using a local Bitcoins from or another exchange from somewhere else, right? I can switch the VPN on and I can use the same services from somewhere else, right? So I think in the global nature of internet and things like that, I think it's very, very difficult to regulate certain activities. So yeah, I guess it's a very difficult position that MES finds itself in. Yeah.
Okay. Any more comments from the panel?
Okay. Well, I guess like in terms of this regulatory status, like of course we are an AML provider, so not from an exchange perspective, but like 3 years ago I did work for an exchange, and back then there was zero regulatory clarity on even cryptocurrency exchanges and what needs to be done. So I think at that time we would find it harder to operate because of regulatory ambiguity, and there would be banks shutting us down or like general distrust in exchanges because there was no regulatory clarity at all. So I think that it is like there might be a short-term phase where it's sort of like growing pains of the industry, but longer run there will probably be a net positive. Like it'll probably split up into two types of players: the more decentralized anarchist cryptocurrency companies who migrate to a place that's less regulated, but the more regulation heavy branches. It could even be a company splitting into two different sort of business operations, and the other business operation happens outside, but it a more regulated protected environment is conducted for its Singapore business. So I think net there is a positive, and you'll actually see a larger amount of larger financial institutions entering into it.
Yeah.
Of course, there was that joke in the beginning of the panel where you're going to see only larger financial institutions entering it. But I think you'll also see a lot of interest from mainstream VCs wishing to back startups. So it might even evolve into something like a challenger bank type of scenario in Europe, where if all these entities are regulated, there's a greater amount of interest. It does de-risk some candidates as such, but of course, while doing it, a lot of discretion would have to be maintained to make sure that the industry is not throttled at all. And I think everybody here sort of agrees with the larger picture, which is user protection. Like a lot of users, like people's grandmothers, housewives may have lost money in cryptocurrencies, ICO scams, or even like market manipulation conducted by market makers on different exchanges. So I do agree with the larger picture, but yeah, I think like iterative steps need to be taken, and with a lot of feedback from the industry, so that it doesn't like constrain the industry in the shorter run or makes Singapore an unattractive destination. So I think that's my perspective.
I think there's less of a chance today of regulatory arbitrage than there was a year ago or 2 years ago. I think that's, and I think Singapore has done a really good job on that, as well as other frameworks, or even the industry has seen the failures of it was easier to go to some other place and it doesn't benefit them in the long run. So I think that will complement Singapore in the long run. But I think it's a bit of a weeding out process too. I think we're probably entities that can't, well, maybe their business models just are not sustainable, right, with this heavier regulatory framework, and that's okay. It's a cleansing process, and the stronger entities or adaptive entities will move forward.
And also with the FedF standards being implemented across the world, I think there's also a certain harmonization of some of the measures. So that's definitely very welcome. Because obviously regulatory arbitrage is obviously not good for the industry as a whole. Obviously, how do you, especially when I'm thinking about travel rule, I'm thinking about, some of the things that you need to comply with, whether you're going to only admit, for instance, a regulated or a licensed service provider versus an unregulated or unlicensed service provider. And then you have to maintain these two sets of and how do you maintain control over them? So, it creates a whole dichotomy. So we need to be aware. I think the main thing is engagement with the regulators, between the regulators and industry, in order to ensure that some of the objectives in terms around AML, KYC, user protection, they are met, but at the same time making sense of the commercial reality of some of this new innovative technology that we are trying to put in place.
I think the best example that I can think of is actually, on one hand, you have a lot of people complaining about the bit license in New York and things like that. And on the other hand, you have a lot of scam exchanges or even scam ICOs and things like that. So I can understand why all these regulations are put in place. But at the same time, we have to be wary of the fact that, if it's too difficult and makes it, too troublesome for a lot of these players, I think a lot of people shift away from that jurisdiction.
Okay. Great. I think we all agree on that. And again, back on the last point that, it's about really engaging with the regulators and understanding this is the concern of the industry, how the industry operates. So, which is why I think for us here, BAS, the panel, the subcommittees, everybody in here are actually trying to really help to do this, represent the industry, help them to, with the regulators to let them understand that this is the industrial concern and see how we can actually get clarity of this. I think this is still very much depending on how they actually view the thing, but definitely we are working hard on that. Okay, moving on to one of the questions that's a bit interesting and it covers the same concern everyone else, right? Is that, oh my gosh, they're coming up with so much regulations again, add on and all that, right? So are the regulations for, especially on crypto digital assets, even some of the newfangled payment services, right, getting more onerous than even for securities, right? That's the question, because it just adds on. For the Securities and Futures Act, you don't hear so much add-ons every other month, but for the PSA, every few months you see some amendments and things like that. And don't forget, there's always the Omnibus Act that is going to be added on from next year onwards. It's still going through a public consultation, right? So the question is that, are the regulations getting more onerous, right? Adding on and on. So to the panel?
No, I don't think they are. I've been around this business for a long time, and if you look at the securities industry, right, it's a 100-year-old business. They spread out their regulations over a longer period of time. We've got regulatory compression. I think that's really what the problem is. I don't think they've done anything out of the ordinary here. It's just overwhelming because the timing is so compressed. I mean, I can tell you when I first traveled to Singapore many years ago, because of at that time, if I wanted to market, I was a member of NYMEX at that time, and if I wanted to market NYMEX, I had to ask for permission to come into Singapore, so this is, and that was 17 years ago. So they're imposing that kind of marketing, framework, and so yeah, to me, it's regulatory compression. It's coming in waves, and it's coming in very short waves, but it's the same thing that has come over longer periods of time in the securities and derivatives industry. So I don't see it as significantly different. It's just because the underlying concept of what crypto began as, not necessarily the Wild West, but it was just an alternative financial universe that people sort of thought it could operate a little bit more lightly, but it's gotten mainstream. Is the reality, right? But that'll bring the scalability and legitimacy to it. So you need to suffer the pains of becoming legitimate. So
I'm going to ask the question to Nizam, especially because Nizam being ex-regulator.
Yeah. He wrote some of this regulation a long time ago.
Exactly.
So he knows what I'm talking about.
Yes.
Yeah, that's how I'm grinning right now. The big bad wolf. Not anymore. I think the answer to the question whether crypto regulations right now is broader than securities is both yes and no. No, in the sense that there are very established securities laws, for instance, prospectus requirements, which have not made their way to the PSA yet. There are rules, insider trading, market rigging, front running, which are not there yet. However, you find, very curiously, the level of scoping of activities for crypto have gone a lot more innovative, to put it in a very mild form, compared to securities. You've got like facilitating transfers, brokering, and advisory is only in the Omnibus Act, but it's not in the PSA. So that's a curious dichotomy. So you've got, I don't know, I get a sense that we're probably trying to introduce too many concepts. We could actually simplify them under a few, basic concepts, dealing. You probably need to broaden the definition, and advisory, and the exchange, and keep it simple. The whole thing about needing to license token issuers, again, is different from securities, as we discussed the Singtel example previously. So that again is a bit of a curious outcome. So I don't know. I think crypto started off in the payment space initially, but more and more you will see a crossover into the investment space, because people buy Bitcoins not to buy Starbucks coffee, right? you buy Bitcoin because you imagine that it's going to hit $20,000 next month.
It might be today. It might be tonight. Yeah, exactly.
It could be a case where. and then even things like market makers in the security space, market makers are completely unregulated.
Yes.
You trade on your own account, but there isn't a similar concept for crypto. So if I buy and sell cryptos as a business, technically I might need to be licensed under the PSA. So it's a bit divergent, but I think there should be some. And I think it's really because different teams are looking at it differently amongst regulators. In some countries, the regulators are different. I think you need to rationalize some of these very divergent regulations.
I also see a bit of it, and just because, again, I mean, I've done a lot of traditional framework and applications. I see a bit of a wish list here. A few of the things that I see creeping up on this regulatory list are things that they would have liked to have gotten into traditional markets architecture, but haven't been able to do it yet. It's an easy application to digital. And also too, they're not operating against siloed exchanges that are SROs, right? So I mean, I mean, there are existing exchanges that stand in silos that are actually protected by their own regulatory frameworks, right? So a regulator actually can't get to them. They can get to digital just by the nature of it. It's decentralization and the universality of the underlying product actually sort of opens it up to maybe test cases for some regulatory imposition.
Yeah, I think just to add on to Nizam's point earlier about crypto being, obviously a lot of people treat this as investment and whatnot, right? Everyone is out there to make more money. And we are in a position where, for ECXX, we're actually applying for both, right? RMO as well as PS, because we're in the sandbox for securities.
Yeah.
So what we do is that we adhere to the higher standard. So I guess whichever is more difficult, we'll take that path.
Yeah.
Which means that we have to comply with TRM, OSPA, cyber hygiene, whatever you name it. We have to do that. So I think that's the stand that we are taking. I think at the end of the day, my 2 cents is that eventually there will be more regulations rather than less, because we are moving in that direction where people are using very, very innovative yield farming and whatnot. All these are basically investment related activities. And in fact, if you look around, there are a lot of IB investment bankers now in this space, right? And that tells you a lot. Yeah.
But I think I sort of agree with all the comments so far, but I think it's important to note that there is a distinction that Singapore law made between securities and a payment token, and now other type of unregulated utility tokens.
Yeah.
So if they really want to have that sort of a benchmark with securities, then they should have lumped it all together into one, and therefore apply the same standard, not trying to overreach one over the other. But I think be that as it may, you guys have made all very valid comments, and I agree with you. But I think the other point that it's missing from this amendment is where we talk a lot about user protection. So one of the things that I was thinking, obviously, is the suitability for the investors. If a lot of people are getting in with investment and a lot of people are still not very familiar, we are talking about a process of education, obviously, and in terms of understanding the investment risk. And of course, we know that there are a lot of scams out there and people are being cheated out of their hard-earned living. So I wonder whether that's one of the key areas that the MAS have either missed out or overlooked in terms of making sure that the people who are, dealing with, Bitcoin tradings or anything, they are at least sophisticated enough to understand the risks and whether the products and investment are suitable for them. So obviously, that wasn't addressed in the amendments or anything in the PSA.
Okay,
so
to add on to this, right, I think there's this comment from the audience and all that is that very interestingly, because I think it's increasingly the regulations that need to keep up and all that. So the thing is that it's the perspective for Singapore that the regulation difficulty level will only increase, and then it becomes a big boys play, right? Only the large corporation with lots of money behind to sustain and to keep up with additional costs and all that, will they be the one that can sustain, while startups and small little companies that come out will not be able to survive the cost of compliance, right? So because if that's the case, then in the way, then it creates the fact that Singapore will no longer be a nice destination for fintech startups, right? Because that's what we wanted, right? Fintech innovation.
Financial inclusion, of course, Kevin, don't forget.
Yeah, exactly. It's about that. But then because of regulations, it's no longer financially inclusive because no one can afford those anymore, right? So the question is then is also that how easy is it for it to apply for a license, given that, incrementally you have all these new add-ons and all that and all that. Is it because it's going to make way for bigger players to come in? And obviously, I think there is a nice little news in the public about DBS getting to become an exchange as well, right? So of course, being such a big, being a bank and being other big players and all that, they wouldn't have problem to comply because they are already complying. So what is your thoughts, right? Is it going to be a big boys play, and then small players, fintech companies will just have to stand at the side, suck the thumb, or probably even leave Singapore because they can't comply, right? So what do you think?
Well, I think it's important to I think one of the safeguard, notwithstanding, I think we are, of course, trying to come to terms with all the slew of regulation in a very short time. And sometimes it does feel a little bit overwhelming. And also trying to understand some of the lack of clarity, some of them, and the fact that we have to try and figure it all out. So, there's obviously that aspect of it, and clearly there are further demands that are being asked of you. And as I speak today, as I told earlier on, that I'm aware that the MAS is looking to issue a new guideline on TRM. So there's another set of costs for that for the players to think about and consider. But I'm hopeful. I understand the fact that you want to put in terms of safeguard for the industry and for the users. But at the same time, I'm hopeful of the fact that they are going to only apply on a risk-based assessment basis. That's clearly one of the cornerstone of what MAS is supposed to do, and look at the various businesses from the fact that in terms of their exposure to the market and the risks in terms of, and then apply some of this regulation accordingly. So if anything, if I may, and hopefully that can mitigate some of the add-on costs that they're expecting us to put into place. But I agree with you that over time, if MAS is expecting the bank standard for a lot of cryptos, I think I think it might be sounding some of the death knell to some of these fledgling players. Maybe it's something is good or bad, I'm not sure. Maybe perhaps the fact that there was 200 over applicants for a DPT license had something to do with it. I'm not sure, but clearly there would be a process of weeding out.
Yep.
I think, okay, my thoughts are these. I think it might be, probably putting it a little bit too strongly to say that, the system as a whole is not facilitative for startups. So that probably might be a little bit harsh. But do I agree that regulatory and compliance costs have been rising? Yes, definitely. And do I agree with the statement that, maybe regulators can afford to take more regulatory risks? Yes, absolutely. I think, you see, one thing I think regulators should do is to actually, before they issue any new regulation, to actually do their own risk-benefit analysis of that new regulation. That will be quite cutting edge, I think. But I think it puts the discipline on the regulator to then really analyze, because with any new regulations, there definitely would be a cost implication to financial services. And some of these cost implications could be really, really huge. So even for the big boys, I've been in big investment banks, when you want to tweak a particular system, internally the cost could be huge. It could be millions of dollars to implement something, organization-wide. Now, so I think having the discipline to do the cost-benefit analysis will be really great, or to have a more structured process on, identifying the extent or the quantum of costs with incumbent players and with new players as well. That would be something ideal. And I think the other thing that needs to be reworked is the sandbox platform. I know, yes, we have made progress. We've introduced the Sandbox Express. That's all well and nice, but it's still restricted to a very few activities. And there's a very high bar to get into the sandbox, even for the Sandbox Express. And again, the whole idea of the sandbox is that that's where you minimize the risks. The regulators take on the regulatory risks. So if there's a fallout, it's contained. But there should be a freer play to get into the sandbox. It should be easier to get to the sandbox rather than to have to apply for 6 to 8 months to get into the sandbox, which is sort of defeats the whole purpose of it. So I think that that's another area for improvement that I'd like to see.
Yeah, we need you in MES, Nizam.
I'm enjoying myself right now.
Yeah. We need a bigger sandbox. That's all. We gotta. Yeah.
I think I actually agree with Nizam here that so fintech is financial services. So in most countries as well, like you do face the whole problem of regulations and complying with them. Even if you're a fintech startup anywhere else in the world and you're starting a challenger bank, you will have an ample amount of regulation.
Mm-hmm.
And financial services has always been akin to like healthcare, right? Healthcare and financial services are heavily regulated because they can actually affect economies and the lives of people. So I think in the whole cryptomania, people tend to forget that. But so this was only this was something that was going to happen anyways. I think the concern that most people have is that it happened very quickly in the Singaporean context, probably over just a year and a half, where everyone's been barraged with a bunch of these guidances, new notices, and several more that are going to come. So I think that was the only issue as such, whereas it is happening all across the world anyways in cryptocurrencies. And yeah, just like having a better sandbox process can still protect the sanctity of fintech startups. And this is also a challenge for fintech startups. It's similar to biotech, where I think if you want to get into like start a cryptocurrency exchange, the idea is that you raise VC funding based on certain parameters first, have the capital, and then enter into like having a regulated licensed exchange, right? So it's similar to if you wanted to have your own COVID drug, right? It's not right to say that you're hampering innovation by putting a lot of licenses. If I wanted to come up with my COVID drug, if all five of us came up with our own homemade versions of COVID, like a COVID remedy, that would create a lot of havoc and disruption on the system. So a sandbox would still facilitate sort of the ecosystem. And I think it won't always be big companies dominating, because big companies have challenges of their own when crypto becomes heavily regulated. The risk for them to get into it straight away, or the cost for them, would be far more than it would be for a smaller fintech startup to be nimble and adapt and start ground up, have a more technology based compliance process, and then eventually get acquired maybe by a bigger company who wants to enter the space. So I think you'll see both of these variations coming about side by side.
Okay. We are coming very closely, and we're going to extend slightly in a couple of minutes just to close off one last question. So last question is on the Custodian Wallet itself. So a question from the audience is that on Custodian Wallet, if a client of Custodial Wallet provider is part of the approval workflow for any transaction on the client's own assets with the Custodial Wallet, does the client comes under the PSA, right? And as well as like about the Custodian Wallet control, because the potentially, let's say for instance, you do not have a private key but have agreement only to control the digital asset. So how does it work out? Do you need to be regulated as a Custodial Wallet provider? Now, what's the comment on this?
Shouldn't lah, is my response, because it's the client, right? So if I'm the client, I need to move the, clearly I'm not providing a custodian service. So I'm purchasing a custodian service from somebody, so that shouldn't be the case. I can understand where Samuel is coming from in his argument, but I don't think that's the intention. Yeah.
Okay. The other one is of course about private keys and all that. So any comments on that? The Custodian Wallet control, right? You don't have the private key by agreement only to control the digital asset. Do you need to be regulated, controlled, or whatever?
Well, private key is not a requirement so long as you have the ability to move or to transfer or control the asset. You're going to be caught still whether or not you hold the private key. But in practical terms, you're likely to hold the private key because it's crypto. But technically, it's not a requirement. Yeah.
Okay. Just one very last comment, and I think that's directed to Migrant from Merkle Science, because I think conversation with some of these, even some of the license applicants, obviously the smaller ones, right? They have no idea that actually they need to actually have wallet validation on the blockchain to validate, to prove to MAS that they is being actually monitored. So maybe Migrant can share a bit, what does it mean? Why is it you need to actually have that, coming from Merkle Science? Not to obviously talk about Merkle Science, but as a whole, why do you think that's needed?
Sure. So I think very clear guidelines have been provided in all the AML guidelines as well as the PSNO2. So earlier AML or KYC would only apply to the fiat layer, where you make sure that your fiat funds are not coming from a criminal. But now with cryptocurrency companies, say ECXX, when they receive Bitcoin from their customers, a new type of compliance that's come about is that you need to ensure that your Bitcoin doesn't come from illicit wallet addresses. And now there are several versions of this. So there is either it comes directly or indirectly from a bad address, which is a ransomware address, a darknet address, the US OFAC list, which is a blacklist of blockchain addresses. So you need to guard against those and make sure that funds don't come from that. And I think with most of these regulatory guidelines, like the FATF red flag indicators as well, they've also introduced another layer, which is that you need to monitor even cryptocurrency transactions for suspicious transaction patterns. So, for example, if a wallet is dormant for a very long time, suddenly becomes active, you need to have processes in place to make sure that you flag out these types of wallets. This is pretty much commonplace in traditional finance. PayPal actually has the most sophisticated fraud science infrastructure in the world, and it's just being applied to the cryptocurrency industry. So I think not just the MAS or the FATF, all the local regulators, even Hong Kong, have come up with mentions of this and the FinCEN in the US as well have come up with mentions of this. So it's a new type of compliance because crypto is being treated as money. So you need to make sure that it's not coming from criminals, essentially. I think that's what on-chain monitoring or blockchain monitoring is about, where you need to apply all your fiat processes to the blockchain or cryptocurrencies as well.
Mm-hmm.
And I think with the FATF recommendations, it goes a step further. It's the same concept, just making sure that money is not coming from criminals. So checking beneficiaries and interchanging like details of beneficiary and the recipient between these exchanges. So I think all these things are gaining a lot more importance now. But just to clarify to Kevin's question as well, like a lot of guidance is already available on the internet. I think most regulators on their websites have also put very detailed like guidances to this. So anybody who doesn't know this or those who aren't aware of it should just read those documents, and that would give them a good idea as well.
Okay, thank you. And I think we have come to the end of the conference. And before I end this, unfortunately, I have to do a bit of advertisement for the Singapore FinTech Festival, as you can see on the screen. So BAS is actually partnering with Switch, which is actually part of the Singapore FinTech Festival, to run the event. So if you have not gotten your tickets, please go ahead and get the tickets and watch the space. Hopefully you get some discounts or codes or whatever from BAS. Watch the space, you'll probably receive any publication. So please go, one of the top events, in fact, the top FinTech event in the world. Please go ahead with this. And then we have some of our members over here. BS actually have a presence over there. Some of our members actually have booths over there. We hope to see you, even though it's an online conference. So with this, I wish to end the event. Thank you very much for participating, and definitely much thanks to the panel. Excellent coverage. And again, this is not one of those webinars where, you know, we just take your questions and we go back and be happy about it. We actually compile everything. This will actually be formed part of the feedback from the industry when we actually engage MAS face-to-face, so that they know the concerns coming from the industry. So thank you very much to the panel. Excellent, really good answering. Thank you very much, as well as participation from the audience. With that, have a very good evening. Thank you.
Thanks very much.
Thanks. Bye-bye.
Thanks, everyone. Bye.